You're listening to the Economics and Country Risk podcast from S&P Global Market Intelligence. In each episode, our experts will provide you with the where, how, and when to make decisions that transform your business.
Hello, everyone. My name is Kristen Hallam, and I am a content strategist at S&P Global Market Intelligence. Thank you for joining us. I want to introduce my colleagues. Jonathan Ablett is an executive director at S&P Global Market Intelligence. Jonathan leads the team in charge of scenario design and new macroeconomic and sectoral economic models. He helps develop customized macroeconomic scenarios for due diligence, regulatory stress tests, impact analysis, and strategic planning purposes. I would also like to introduce Harvey Tomacic, credit product specialist from the Credit and Risk Solutions business at S&P Global Market Intelligence. Harvey provides analytical expertise, advisory, and risk solutions to financial institutions, professional services, regulatory authorities, and corporates in areas of credit risk, regulation, transfer pricing, macro and climate stress testing, and sustainability. Thank you, Jonathan and Harvey, for joining us today. We will have a lively discussion on the economic outlook in light of current instability. So, Jonathan, it's a really volatile time, to put it mildly. How do you begin to think about economic instability?
Yeah, it's a good question. Probably it's a nice way of level setting, even if we're going to talk about the outlook, right? The way that we think about forecasts is often we're building up a baseline, we're evaluating the data, and then we're looking at the balance of risks across a relatively narrow range of highly probable events. And that helps us say, this is a baseline outlook. It's not going to be perfect, but it's a story that is consistent and helps clients, help people make decisions, right? The challenge is we always have these known unknowns or unknown unknowns that are percolating in there, right? And so when we do regulatory stress tests, that's what you're talking about. You're talking about those extreme shocks. We've gone through a pandemic. We've gone through a, frankly, industry and global economy shifting war that is not yet done, right? And we don't fully know the broad implications of that. So people have this evidence of these tail shocks that are coming in that are really starting to shape what we view as our baseline. So it's a different way of thinking about things. And so when I'm looking at things now, we're often asking questions about geopolitics. How does that flow into it? Domestic politics, depending on the country. We're looking at climate increasingly, and we're looking at technological change. All of those are combining to affect things like supply chain, like decisions about where to invest and how to introduce resilience into the system. In talking about it with colleagues, the image that comes to mind is we borrow it from physics. It's almost like a phase shift. We were in a period, and now we're in a period of change that will lead to another period of stability. But we don't know what the other end is going to look like. So I don't know if that helps, but that's how I tend to view things. There's a lot of things that are tail risks that are starting to creep into how we think about baselines.
I love the physics metaphor, Jonathan. Harvey, how does economic instability and the economic outlook impact credit risk?
I can say that from my end and from my angle, we are also exploring something very interesting, both from the methodological aspect, but also in terms of observing what are all the macro variables that are still changing. Namely, when we are looking at macro variables impacting the credit risk, historically we observe that typically we would have one macro variable changing and the rest staying relatively stable. Just imagine about the interest rate being relatively stable and then suddenly shifting at the same time, where we are exploring the inflation increasing, GDP changing, and so many different macro aspects and macro variables changing at the same time. So what we are now exploring and seeing on the credit risk point of view when we are performing the analysis and the simulations is that we are having all these macro variables changing and impacting the credit risk trend. So I think it's not just about having interesting results, but we're going to go through times where not only the uncertainty of economic variables that we'll be facing, but also the results, because there will be so many different dimensions, both from the input side and the output side, that we'll be going through in the upcoming months or even years. being also under market intelligence, we have the capacity and the capability of applying also methodologies that are not purely looking at the credit risk aspect across the globe and different industries, but also in terms of building the methodology, we have much more freedom. What do I mean with that? So we have the capacity internally to create methodologies that are statistically replicating the ratings output. So creating a credit score that has been independently developed from the ratings to see where might be the direction, the trend of the ratings itself. But at the same time, we have methodologies that are also looking at the wider horizon, not only those that are typically assessed by the ratings, but also smaller and mid enterprises, and therefore applying methodologies that are slightly different, and therefore looking not only the impact in terms of what would be an expectation for S&P Market Intelligence to look at the credit risk, let's say from a traditional angle, but also in terms of looking at very small companies, private segment, how they will be impacted by these macroeconomic trends, and therefore giving a different time dimension in terms of what might be the short or the mid horizon in terms of the immediate impact, looking at these macro variables changing.
I'm glad you mentioned those capabilities, Harvey. It's one of the unique value propositions that we have here. Jonathan, what is the current outlook for the economy and the key assumptions that are in that forecast?
Yeah, absolutely. It's interesting going back and looking at how we've evolved even this year, right? So at the beginning of the year, we expected that there would be a recession about halfway through the first quarter. It looks right now as if we will avoid a recession, right? A sort of technical sense. But I think there's a lot to unpack there. What we can say confidently is that we are in for a period of below trend growth, where in order to deal with things like high inflation and low unemployment, which ordinarily sounds good, but is a sign that the economy is overheating, rates are going to have to remain high for longer than we expected. Indeed, I think our sort of projections and our scenarios of what rates could look like are now higher than they were at the beginning of the year. And we don't expect that's going to be reversed anytime soon. You're probably looking at high rates. I think right now we're at about 5.25 on the Fed rate for the rest of the year. That means we're going to have below trend growth as demand and supply come more into alignment with each other, right? And I know we're going to get into it, but things like what's going on in the banking sector and what's going on in the debt ceiling discussions, they add nuance to that policy, right? They can either push rates higher or lower depending on the outcomes of where those are going, right? So we're looking at below trend growth this year. We expect that high inflation will persist in the US, that it's going to take a while to work out what's going on. We're seeing it quite strong in both core inflation and in the service sector. And the service sector is where folks were generally concerned that it would start to permeate. And in fact, we're starting to see that higher inflation in the service sector. So it will take time for the impacts of interest rates to work through in that case. And that means lower growth. Okay. Similar story in Europe, right? They don't have the debt ceiling issue to deal with, but they may have to deal with the fallout. There are more complex issues in Europe, obviously. We can see the risks of either inflation persisting more. We can see the impacts of a new energy spike, an expansion of the war. We just don't know. So that's the risks broader when you think about Europe. But they are in for a similar story, right? They had a minor dip in growth at the end of last year. Again, looks like they'll avoid a recession, but they're really on a sort of knife's edge in terms of growth rate. The exception to that is China and elsewhere, right? China, India in particular. China's just exited from the COVID policy. There's signs that the recovery is strong. It's China, so it's driving a lot of growth. So we expect that APAC and that part of the world will continue to drive growth. And then as demand in advanced economies starts to return, when rates start to fall, we're looking at next year again, then that creates an additional reinforcing mechanism in APAC and the rest of the world. So that part of the world we're more confident in. That's the broad outlook. So low trend outlook growth, higher inflation in the near term in advanced economies, and higher rates, and then ultimately APAC looking a little bit stronger.
Thanks for setting the scene for us there. Harvey, are we seeing a difference in how industries are being impacted across these different regions?
Yeah, absolutely. And thanks to Jonathan to opening up not only from the US perspective and European, but also towards APAC. Not simply because there are different macro aspects across the globe having different trends. And also, even if there are same trends, like, for example, comparing US with Europe, but the magnitude will be different. And this will have an impact exponentially also on the industry. So we've done some analysis that was perfectly timing with the banking, let's say, mini crisis that we've seen in the US, where we identified already a few months ago that the current macroeconomic conditions will have, in relative terms, a high impact on banks and utilities, and particularly this low economic growth, high costs of debt servicing, and inversion of between the short-term and the long-term interest rates. We're having, particularly on the banks, being the one across different sectors and some industries being those that were the most impacted. And there are other industries that we see that will be also to some degree negatively impacted, not only utilities, but real estates. And here, for example, we see then with different magnitude, the real estate being impacted, for example, particularly more in UK respect to other Western regions such as US and the European area. Now, moving globally and moving to other regions, we see now a shift in terms of this trend. So, for example, if we stay within the banking and real estate industry, in relative terms, we see, for example, in China, improving the situation. So we see how same industries in different regions are suddenly having a different direction in terms of where their risk will be increasing or decreasing. Now, in the US or in Europe, we do, however, see some improvements with our forecasts, even with the current macroeconomic conditions. For example, we'll see some improvements in the healthcare and particularly pharmaceutical industry, information technology, and aerospace and defense being particularly positively, let's say, respect to other industries impacted by these macroeconomic trends.
Thanks for highlighting some bright spots here and there for us, Harvey. Let's go back to the debt ceiling. Jonathan, you mentioned that earlier. How could that situation play out?
It's top of mind, certainly in the US when we're looking at the economic outlook, but it does play out globally. One way of thinking about it is we can roughly divide into three cases, right? One is we had this sort of repeat of what happened in 2011, where we went all the way up to the possibility of default and agreement was signed at the very last moment with a lot of drama. Another alternative is we go up to that point and there isn't an agreement. There's a sort of technical default that ultimately there is an agreement, but in the near term, there's this technical default, which has serious consequences, but still is short of what would be considered a true sovereign default, which is the US not making interest payments or principal payments, right? That last scenario is, in some sense, it's so far away from what we would expect at this point. There are plenty of resources enabled for the US government to pay its debts, right? To refinance. That's not what the issue is at this point. It's not. And because of that, if there were a default, a true sovereign default, that would just convulse markets. So it's in its own analytical class, right? It would just convulse markets in ways that we're probably not prepared for. But the first case, the 2011, is probably pretty close to our baseline at this point. And there's a non-trivial probability of a technical default. So it's worth focusing on those two things. The 2011 crisis is interesting because you get these sort of very odd behaviors that would affect credit performance, how that plays out. One is we start to see spikes in CDS rates in the run up to 2011. You start to see CDS, the cost of insuring short-term debt, effectively spikes in that period. And then you start to see volatility in indices like the VIX. And eventually, as it gets very close to what we're calling X day now, right, the day when the government won't be able to pay, the S&P started to fall sharply, right? So ultimately falling 15, 20%. So the reason I say that is we are already in a point where the CDS rates have risen sharply. Now, they've risen sharply in some sense related to what's going on in the banking crisis, but you could argue that should be going the other way. The CDS, the 1 year, is already approaching the 5-year rate, right? Which is exactly what happened in 2011. Less motion on the VIX, and the S&P 500 remains relatively placid, if you will. But weirdly, that is a lagging indicator in this situation, that the equity markets aren't going to make a decision until it becomes really clear which way things are going and whether that the perception changes of how likely a technical default is. So that's what happened. And what followed, we've become used to this, but it is still an odd set of behaviors, right? The US government moves towards technical default, and the yields on the 10-year Treasury notes start to fall because there's such a demand for such a stable asset. So equity risk premiums fall, the yields on those notes fall, ironically. The dollar strengthens as asset managers and elsewhere seek quality and seek assurances. And then weirdly, you have things like mortgage rates rising or the spread with mortgage rates rising. So these different currents across the financial markets start to play. So it's very much a convulsing of the financial markets. We would expect that to be magnified in the case of a technical default. So you're talking the 15, 20% decline in the equity markets and so on and so forth. However, it's compounded by the impact of the government, the federal government will instantly have to constrain its spending to any revenues that exist with zero cash in those first 2 weeks, right? So that means cutting off unemployment benefits. It means cutting off any discretionary spending. It will require some prioritization likely on non-discretionary funding. So that's the challenge you face immediately. That is spending that is going into the economy that will all of a sudden stop. So instantly you have a massive contraction in federal spending that impacts overall GDP. It impacts consumer spending and so on and so forth. The equity market impacts will have wealth effects on consumers. The good news is that in many cases, once a deal would be arrived at, a lot of that will come back. And so you do see this rebound in growth in 2011, a minor dip of growth followed by a surge where there's a recouping of that spending as accounts get paid out and contracts get paid on. So that's the broad picture. Looks like 2011, the politics have changed. There's a lot more volatility around the political environment than there was even in 2011. And there was a lot then. So that's what has us very much concerned at this point.
As if we need any more drama when it comes to the economy.
Yeah, it's a really good point. Right? We're expecting a lot of drama, right? Like if you're in this space, your Memorial Day is probably ruined because June 1st is X Day. Oh. So if you're following this, it's likely that last weekend is going to be very busy and full of drama, and we'll see. And it is entirely possible, although it seems off the table right now, that we see a short-term extension, that it doesn't actually get resolved, that it just gets pushed back. But we simply don't know what we don't know on that front. And so the only thing we're comfortable projecting, apart from what I've just described in terms of the 2011 brush with default, is actually a lot of drama for the next 3 weeks.
I'll put a rain date on my barbecue invitation for Memorial Day weekend. How about that?
There you go.
So how will this potential debt ceiling drama interact with the ongoing banking sector challenges that we've seen recently?
We talked a little bit about that, right? So it's connected and not connected. Think about the banking crisis. What has happened is rates have risen from a very low level for a very long time, right? And I think that's the key here. Every time rates rise, there are instances where banks will fail. There are individual banks that can mismanage their asset portfolio and whatnot. And that, in some sense, is the story of Silicon Valley Bank, for instance, and some of the others, right? It's these large unrealized losses. The pressure leads to a bank run. And so, in some sense, it's not unexpected. There are some nuances absolutely around this. Was there enough regulatory supervision? What was the role of clawing back some of those banks from the tight supervision that followed the global financial crisis in terms of stress testing, disclosures, and whatnot? That's all there. That's the context, right? We would expect some banks to fail. And our baseline is similar. We do expect that given the high rates and the persistence of high rates, there will still be banks that fail. I think where we're concerned is that we haven't seen the fallout globally yet. And yet there's some evidence that in other regions, Latin America, Europe, of systemic level unrealized losses. So the same situation that you saw with an SVB, for instance. So there's that. And that effect still hasn't permeated. The confidence that we have is that this is a different situation so far from what we saw in the global financial crisis. This is not a liquidity and this is not an asset quality issue yet. It is primarily a liquidity issue. And so far, the Fed has been able to put in place measures that should guarantee the liquidity of these banks for at least a couple of years. So this effectively inoculates some of the market from some of the liquidity concerns that we've seen. Now, we're still seeing pressure in equity markets on some of these smaller banks. It's not clear why that persists because by most measures, they have plenty of capital. The capital adequacy ratios are fine, they're stronger. And that's actually a general statement. Most countries, most banking systems are stronger now than they were before the global financial crisis. We haven't seen the same kind of credit bubble that we saw in the run-up to the global financial crisis. So globally, there's a sort of relative strength in the banking system that doesn't suggest we're in for a bubble at this point. The other questions that we're continue to be concerned on, right, are things like what's going on with emerging market debt for the interesting reason, not only rates are higher on that debt, but we haven't seen the lack of access to those markets. They continue to pay, but it becomes a risk. Why it matters for banking is that many of these emerging markets have banking systems that have become more concentrated in domestic sovereign debt, so more exposed to sovereign debt, which is now getting devalued in the market, in the secondary market, as rates rise. What we're watching now is there going to be an acceleration of the quality of the balance sheet for these emerging markets in terms of their risks and the banking crisis? What's going on right now has introduced a whole other channel through which we could see emerging market challenges on the financial side. That's the context around the banking crisis. Where it interacts with the debt crisis or the debt ceiling debacle is mostly on that last scenario that I described. We're okay in principle if there's a technical default, a short default. It will be convulsive. It will matter. It will have near-term economic impacts. However, what really matters is a full sovereign default that will undermine the full faith and credit of the United States, leading to the question, okay, what is the anchor, the risk-free rate for some of these deficits, and how should we be pricing some of them going forward? So that's the major concern going forward.
Thanks for that. Lots to consider there. So Harvey, what can you tell us about credit risk trend outputs from different models like the shadow rating versus probability of default?
Several things there. Having the capability to have internally different methodology enables us to look at different credit risk trends that have been built with the different philosophy in terms of what they are trying to predict. And in doing so, different cohort of observations in terms of companies that are composing that industry were used to perform that analysis. And therefore, when we project the forecasted trends, it's also applied on a different cohort. What does that mean in practice? Namely, having a macroeconomic stress on a methodology that replicates a methodology that it's inspired on the ratings, it's typically ratings by itself are being assigned to large corporates, relatively well, let's say, allocated in terms of their business of multiple products in different regions, and by their nature tends to be also more stable as an output. Now, that means that when we apply this methodology on those, or the stressing on this type of methodologies that are replicating the ratings trends, we typically see that the output is more stable through time, even under certain severe macroeconomic abrupt movements. But also given their nature that the underlying, it's well distributed across different regions, macroeconomic trends will have a different weight since the company itself will be perhaps exposed to different regions. For example, this exercise, it's very interesting, is particularly when it comes to apply this macroeconomic stress on methodologies that are now separating itself from the ratings universe and they're now going to the private market or stressing the purely, for example, public companies. So we see that, for example, public companies might be more stressed by some market economic trends or market sentiments, and being therefore much more impacted by, let's say, news from some supply chain disruptions, or let's say the movements or the policy that have been implemented by the ECB or by there are a few more methodologies on which we apply the macroeconomic stress, and those are particularly looking on stressing now the trends, particularly on the private segment. And here we see a much more heterogeneous landscape in terms of the results, where the magnitude of the trend of the credit risk it's much stronger, and we see how each industry within different regions is being much more impacted. Having this type of capacity of looking at the market from different angles when we look at the credit risk enables us also to see where ultimately the macroeconomic stress will then fall the strongest. And in that sense, we see that particularly as we are moving more to smaller companies that are more exposed to supply chain disruptions or to having high leverage where their interest rate or the cost of servicing the debt might be particularly sensitive. We see this very strong and sometimes almost diametrically opposite results when comparing big companies with respect to small companies, applying a methodology that looks purely at the rating movement with a mid to long-term horizon in assessing where they will be, or looking at the short-term horizons, identifying where will be the credit risk movements in the next 3, 6, or 9 months. And obviously here, particularly when we come to the smaller entities, smaller companies, smaller size, looking at the impact in the short term, this example of the real estate was particularly evident, and we saw different magnitudes and strong trends in terms of their credit risk deterioration or improvement condition to these macroeconomic variables. When it comes particularly in supporting either a specific case study analysis or supporting clients or specific, let's say, goal in terms of understanding what is the purpose of this analysis, then choosing a specific methodology starts to be very relevant. Adopting a specific methodology for short-term horizons, so looking particularly on the private segment rather than big companies that are rated, well-distributed, starts to be very important in order to see particularly where, for example, the supply chain disruptions might impact, particularly the entity that is exposed with their portfolio through investments or even through their supply chain within their business, and starts to be very important in hedging those dynamics and those risks respect to just purely looking at the long-term horizons where this volatility and migration of the risk of the scores and PDs might converge to be less volatile.
Thanks for walking us through that, Harvey. Obviously, a global shock will affect different companies, different sectors in different ways. Each sector could have a different exposure. How can scenarios help with that analysis? Jonathan, maybe we'll go to you first and then Harvey can tag in.
Yeah, absolutely. There's a couple of ways you can use scenarios and alternative projections. So one is narrative-based scenarios. That's really useful in a situation where you have uncertainty about outcomes or direction, but you have a clear idea of what the alternatives are. So you start to build a story that is logical, that leads you down a different path than you might think is the high probability story. We in the initial days of the war in Ukraine, looked at it. This could be very quick, and there could be a return to normalcy after the initial shock wears off. That might take this many months and the trade gets restored. And that was our optimistic scenario. And then you could look at it alternatively and say, actually, wait a second, what if Russia is completely isolated, which turns out to be more extreme than the reality, but is probably closer to the reality than has emerged. Right? So it allows you just to evaluate those different alternatives. The other way we like to think about it is probabilistically based. There's plenty of data in terms of the history and the behavior of these variables and how they move together or not under certain conditions. Right? And so we can start to chart and develop probabilistically based scenarios. Broadly, what are we talking about in terms of 1/3 upside or downside, or 90% or a 5% scenario? So it just allows us to do that. And so we can exploit different techniques to generate and that are internally consistent. What that does is it helps Harvey, right? Something like GDP is very abstract. It's very large. It's hard to wrap your heads around, and you need to get more specific. To make good decisions, we need more specifics around interest rates and spreads and unemployment rates and inflation. And so it's having that consistent expansion with either these probabilistically or narrative-driven scenarios that helps inform other models. That's how we tend to use scenarios.
Harvey, anything to add there?
Yeah, maybe reinforce what Jonathan said. It's really helping in creating the narrative. Being able to be more precise and narrow down a specific shock, or having different scenarios where each scenario, rather than being generic, really tries to identify what is the cause of that eventual macroeconomic trend, change, movement, ultimately helps us also to, in a much easier way, identify then when we are applying it on an industry credit risk trend, understand what is happening in the background, what is happening to that industry, and having also helping us ultimately to transition the narrative from that specific macroeconomic case that can be led by political, economical, or many other specific reasons, then of, let's say, transition then on a micro level, then see what happens on the industry level, how that specific scenario is then impacting the industry and helping us in then creating the narrative, and understand then eventually also narrow down on a company level what are the risk dimensions that the company is facing in that circumstance.
I like thinking of these tools, these methodologies, these scenarios as storytelling, ways of storytelling. Let's step back a second, Jonathan and Harvey, just to talk about how we can help clients think about industry and credit risk, and how do we help them map that out?
So when we work with clients on scenarios, right, whether they're credit or not, because there are many different applications of scenarios, right, one of the things we try to do is to articulate what are the concerns that you're facing, that you see with your business, that the risks that you see. We might have additional lists of things that's in our universe of risks. So we then try to articulate, okay, what are the dynamics that affect you as a client in your industry or your markets or whatever? And then start to connect that sequentially to what is the dynamic of that risk. Is it a sort of very sharp spike, or is it a prolonged, permanent, or growing risk over time? The biggest example right now is like this. There is something very different in terms of the behavior of the risk dynamic of physical risk in climate change. So the risk of fires and floods and the like, versus transition risk from different policies, different technologies emerging, volatility. Those are different, and they have different dynamics at play, right? So we try to look at what that dynamic is and then start to link them through to what we have in our various sides. Echo what Harvey mentioned earlier is it's probably not best practice to just rely on one model. That's why we find scenarios useful. That's why we like to test alternatives and alternative models and run them through different pieces that come together. It adds a sort of robustness to the analysis that is useful for clients. Ultimately, you can be more confident in the conclusion than not, right? So that's how we tend to work from the macro side.
I think this is the best part of all this analysis, is how we can help our clients. First of all, they can leverage not only the work that our team is doing within the credit risk assessment, but also connecting with Jonathan's team. And as he mentioned, helping identifying what are the risk dimensions that are surrounding the client's business environment, and then translating it then ultimately into the credit risk, in my case, to see how we can then leverage those in identifying then the assessment of different credit risk dynamics that are surrounding now either the client itself or the surrounding of the client. It connects to what previously I have introduced in terms of how the macroeconomic scenario can have a different impact and magnitude on different models. And these different models are exactly made to help clients for different purposes. So helping a client who is facing supply chain management, it's much different from helping a client who has investments and wants to see how their portfolio towards bonds and equity might change. The same thing also changes the moment you are using a different methodology, that it's more volatile because it's built and looks at the private sector more than respect to ratings. It's ultimately recreating a transition metrics in a different way that can help in identifying or leverage both methodologies in having a more volatile or a more stable migration metrics for constructing a portfolio transition for a bank, or even for someone who is managing collateralized loan obligations and wants to see how their transition of their loans will migrate under different assumptions, but also different methodologies. So having all these tools and also connection with our economic and country risk team helps us in really putting together the strengths of different teams, but different methodologies for different use cases.
So all that's left to say is thank you, Jonathan and Harvey, for sharing your insights with us. And thanks to our listeners for tuning in. Join us next week when we will dive deeper into the forces at work in 2023.
Thank you for listening to the Economics and Country Risk podcast. Connect with us on LinkedIn and Twitter, and don't forget to subscribe to the podcast so you never miss an episode.